Hey everyone, welcome to Chart Strength. My name is Zora Tour, and today we're going to be doing the trading journal for March 2nd. It's the second trading day of the month of March in 2023, and I'm going to go over some trades that I've made today and even some trades over the last few days and a couple charts that I think are going to be really interesting for you to view with me. We'll look at some new breadth indicators and our typical charts that we've been annotating, editing along the way since the beginning of January. Wow, can't believe it. We're into March already, so let's dive right in and take a look at some of the charts I am viewing. Okay, boom. All right. So the first chart that I thought I'd show you guys, let's zoom in, is a new one actually. Let's move this one over here. This chart here is for the AAII bulls. So this is more or less like a sentiment gauge on what investors are feeling right now in the market. So sentiment indicators are usually used as contrarian indicators. So if everyone is super bullish, then maybe you need to be bearish. If everyone is super bearish, then maybe you want to start to become bullish. So it kind of gives you an idea to where to position yourself. All right, so what we're seeing here is basically the bulls fell actually most recently in February. February is a really weak month. You'll see the bears pushing out. And even below here, we still haven't seen the same bullishness come back into the market. Again, February was a really weak month. There was a lot of selling pressure, albeit not very strong. There was selling pressure, but not very strong, which I'll try to go over and show you guys. So here is basically it's telling us to maybe consider long-term upside. Okay, so that's that chart. So where are we here? We did that one. Okay, here is another a breadth tool. Breadth tools are really good to use because they can tell you what the broader market is doing. A lot of the times, I think market participants get caught up in big cap names like Nvidia, like Apple, Tesla, like what are these guys doing? What's China doing? What's K-Web doing? That doesn't really matter that much. We want to see what the broader market is doing. If you're playing with large pools of money and you're managing your risk, I think breadth is really important. If you're a gambler, then yeah, by all means, go buy yourself some random individual stock that has a lot of risk. I do that with calculated methods, and I usually pair it up with a broader index or a broader ETF. But so let's just dive right in and see what we're looking at here. Okay, so we've got the common stock advancing minus declining issues. What I want to take your attention to is right over here, is towards the last week and a half of February, the number of stocks that began advancing increased. You can see that here. So the number of, well, maybe in other words, we could say the number of stocks that were declining was less. So this, to me, is a bottoming signal. We can go back in October and see something similar as well. You could see that in October, the number of issues that were declining on average was less. That was a bullish case, and eventually you had this big bull run into basically December and then a little bit into the new year. And February has sold off. So okay, this is the S&P 100, but what I want to take your attention to is the put-call ratio. Again, the put-call ratio can give you an idea of sentiment. So if there's a lot of puts being written, that means there is more of a bearish atmosphere. And if it's too much extended in one side, you might want to take the other side, a contrarian view. Okay, so let's take a deeper look. So what we see here again is in February, the number of puts started to increase. And again, in this one as well, equity put call ratio. So this one just focuses on equities. The CBOE, I think, encompasses a broader set of securities. So you'll see a surge and a surge in put writing, put selling. And I think that was probably due to mostly the hot inflation data that's come out and the expectation that rates are going to be higher. There's a lot of Fed speakers this week, even today. I think Collins and Bostic were out there talking about the desire, the willingness to push rates even higher. So that's what I think is attributing to this high put selling. Let's move on to the next one. Okay, this is where I've been placing sort of my risk and return zones. I actually have to update. This is not updated. This is from my previous trades from, I think it was January, basically January 3rd, we placed some trades. Yeah, here and here. I can see that we got stopped out, but now I've entered back in. My average cost is just around in this area here. It's a little bit too high than I wanted, obviously, but we'll continue to monitor it. We've got the stop loss in place. I increased my risk level just a little bit. I still haven't gone past 2% of my total risk capital. And I'm at 1.5%. So I'm being very conservative, but aggressive in the same way because I'm allocating more dollars to the market. I don't want to be wiped out. Okay. Let's skip over to the Dow. Oh, this chart I really wanted to show you guys. Let me see if I still have the other one. Okay, let's just focus on this one here. So this one is a again a sort of reoccurring pattern that someone developed. I forgot the fella's name. I think his last name was Hooper, but basically his idea was that if you take a look at where December is, and then from December all the way to January, February, March, if by Q1 prices come back below the December low, so this is the December low, if prices come lower, that is a early warning sign. So that means maybe you want to take a step back. So what is actually doing now? Price is held. It didn't break below. So far, we still got like 20 trading days to go, 18 trading days to go. But this is a early good sign that maybe we found the bottom. This whole area here, basically from November till now, the Dow has been consolidating. The Dow was the leader out of the October bottom. And I think it just spent a lot of time consolidating. And my thought is that a lot of the money that was made there maybe is moving into tech, because technology is seasonally very strong at this juncture, at pre-election year, at the beginning of the year. A lot of factors are in favor for technology and small cap. So even if you look at the IWM, it's a leader. Okay, so what do we have next? This one here. Okay, shoot. This is it. Okay, let's change this up. All right, this is probably the most important chart that I wanted to show today, is why I think maybe the market has given us a bottom. Here's our low is at 32,500. Our lows here were 32,581, 32,573. Okay. So we didn't have a significant cross below the December lows, as you can see here. But where I want to take your attention is right over here. Okay, this is the MACD histogram. So from my understanding and my previous patterns where we've made money, is this. You have a low here, prices rally, and then you get another low at the same level. You see here, 32,500 we'll call it. What I do then is I look at the MACD histogram, because the MACD histogram to me tells us the strength of the move up or down. It's sort of like a strength tool for me. So here the MACD histogram is very, comes down a lot. But here, while prices came down to the same level, the MACD histogram did not. It was shallower. So this to me is a bottoming indicator, and I learned that from the book Come Into My Trading Room by Dr. Alexander Edler. I highly recommend that you take that book. I think it changed the way I viewed prices or the market. It made me focus on prices more often and really save my ass from losing money, and only just help me be more consistent with my trading. You're going to take losses along the way. You're going to get greedy along the way. You're going to get fearful along the way. But anyways, so this divergence is key in my analysis. Hope I'm right, but we'll see how that goes. So that is a really good chart that I wanted to show you. Where are we next? Oh, right. Another one is the move between is the look between what the Dow is doing now and what it did in 2003. So I should have set this up better, but the move in the Dow from 2001 to 2003 seems very similar to right now. We had a big sell-off, a rally up, and then a rally back down to the previous lows. Here is October and March, and then a rally. Maybe that's what we have here. And it's only based on the fact that people have short-term memories. People have always go back to previous markets or what they did, like I'm doing now. And I think that might play a role in how the market moves. All right. This one here, we're just taking a look at the Bollinger Bands. I don't use Bollinger Bands a whole lot, but I do have it in my arsenal. You want to use a Bollinger Band in conjunction with the RSI. If it gets too oversold and it's hitting here, you can look for a bounce back up to its standard deviation. So we have two standard deviations from the 10-day moving average, and prices are typically going to stay range bound. That's sort of the idea. Things are quite oversold here. And this is the 26-week moving average. It's a good long-term directional average. Prices are holding above. We're seeing a bounce up today, so that's good. But we need to monitor it because on a weekly basis there is some weakness, although we're still above the zero line. So I think we would expect prices to keep moving in an upward bias. This is our famous best 6 months chart. You can see February, we were expecting it to be very bad according to the Stock Traders Almanac. You need to get this book, guys. What I'm expecting now is a move back up to here in over March and April. So that worked out nicely, just like we were expecting. Again, here's my chart highlighting all my notes. This is a major current, most relevant trend line. Price did dip below, but it looks like it's trying to get back above. And I added my notes. I think it's really important that you add notes to your chart so you know what you were thinking and why you did it. The VIX, what we're seeing is a break of the VIX below its 21-day moving average. Bullish sign. Okay, we'll continue to monitor it. There is a bit of an uptrend since February. We want to see this actually break and hang out below 20. I think the VIX below 20 is very bullish for the market. The new high index, here we're still holding up. All right, so that is my charts for today in my trading journal. To recap, feeling pretty bullish given the divergence in the MACD histogram in the Dow Jones, and given the seasonality of technology and small caps, I placed a trade. Only about 20% of the portfolio is invested, and we have only risking about 1.5% of our portfolio capital. All right, Hope to see you guys on the next Trading Journal. Have a great day.